Hi, welcome to our channel of IGNOU audiobooks, Indira Gandhi National Open University, School of Vocational Education and Training, Sovet, Diploma in Business Process Outsourcing Finance and Accounting, Dbpofa, revised. Bpoi 103 Procure to Pay, P2P, Accounts Payable, Unit 3 Source Documents and Vendor Master Maintenance. 3.0 Objectives. The objectives of this unit is to familiarize the learners with the source documents used in a P2P cycle, the utility and significance of the source documents, and the information provided in the source documents. 3.1 Introduction. Source documents are the testimonial that carries information on the transactions done by a business organization with outside parties as well within its own department's business units. Therefore, the source documents are of two types. 1. Internal source documents. 2. External source documents. They are used to convert a commercial transaction into an accounting transaction so that the organization can recognize the transactions in its book of accounts. They are also referred to during audits and quality checks to establish whether the transaction have been recorded correctly.
Accounts. They are also referred to during audits and quality checks to establish whether the transaction have been recorded correctly. 3.2 Types of source documents. As mentioned earlier, the source documents are of two types. 3.2.1 Internal source documents. They are the documents that are created within an organization for internal use to help carry out transactions between one department of an organization and another. A. Purchase requisition, PR. This is an internal document. A purchase requisition is created by a user department and sent to the purchase department when any material or service is required. For example, HR department may need printer and stationery, production department may need raw material, and finance department may need professional services from an external tax consultant. In all the above cases, the respective departments will create a PR and get it approved. Subsequently, it is forwarded to the purchase department. A purchase requisition typically contains the following information. Since the purchase department cannot make any purchases without receiving a PR, without this control, the purchase department may order goods that may not be required or place order for too much or too less of some material. A sample PR is shown below. Fig. 3.1 Sample Purchase Requisition. B. Good Received Note, GRN. This is a document created by the buyer at the time of delivery of goods. It is a record that the specified goods have been received by the buyer. A copy of this is also shared with the seller. Look at the screen. Figure 3.2 Sample GRN. 3.2.2 External Source Documents. They are the documents that are used by an organization to share information and do business with external parties like its customers and vendors. A. Purchase Order, PO. A PO is a commercial document issued by a buyer to a seller. Once the seller agrees to the terms of the PO, it becomes a contractual obligation for both the buyer and the seller. The seller has to supply goods and services as per the terms stated in the PO and the buyer. Types of purchase orders. 1. Standard purchase order. They are most commonly used purchase orders. In this case, the buyer has all the details about what she is buying, like quantity, price, delivery schedule, etc. 2. Blanket purchase order. This is used when low-cost items, e.g. stationery, or low-value consumables, are purchased frequently. The PO is issued with a limit on the purchase amount. Within that amount, the buyer can keep ordering material as frequently as required. When the PO limit is exhausted, a fresh PO is created. Increase of the blanket PO will help to reduce the manual intervention in invoice processing, as the PO will always be ready with the funds. A sample purchase order is shown below. Look at the screen. Fig. 3.3 Sample Purchase Order. B. Invoice. An invoice or bill is a commercial document issued by a seller to a buyer, indicating the products, quantities, and agreed prices for products or services with which the seller has already provided the buyer, and requesting payment for the products and services provided. Look at the screen. B. Invoice. An invoice or bill is a commercial document issued by a seller to a buyer, indicating the products, quantities, and agreed prices for products or services with which the seller has already provided the buyer, and requesting payment for the products and services provided. The invoice can be sent to the customer. 1. Either along with the shipment of goods. 2. Or after the shipped goods have been received by the buyer. Most of the vendors wait for a proof of delivery to reach them before the invoices are sent. The accounts payable debt, on receiving the invoice matches it with the purchase order, PO. Either the buyer can raise a debit note or the vendor can raise a credit note. The credit note reduces the vendor's receivables from the customers for the goods returned or excess payments, overcharges against any invoice, credit entry in the account books of the vendor. Debit, credit notes are also used to adjust the revenue recognized by the vendor against the selling transaction. A sample credit note is shown below. Fig. 3.5, Sample Credit Note. Look at the screen. 3.3 Summary. Source documents carry information on commercial transactions done by a business and are used to translate these commercial transactions into accounting transactions. They are also used to verify and audit the correctness of the accounting transactions. Some of the source documents that are frequently used in a P2P cycle are purchase requisition, purchase order, invoice, GRN and credit note. When some material, services are needed by a business, the need is communicated to the procurement department using a purchase requisition. Based on the purchase requisition, the procurement team selects the vendor and sends him a purchase order indicating their intention to purchase the material, service. Once the vendor ships the goods across, the goods received note is created. The received goods are checked for quality and then accepted. The goods that do not meet the quality standards are rejected and returned to the vendor. When the goods are returned to the vendor, a debit note is raised by the buyer or a credit note is raised by the vendor to make the related accounting adjustments to recognize the return of goods. Vendor sends an invoice to the buyer providing details of material sold or services provided and requesting the payment for it. Thank you for watching. We will see you in the next video with the next chapter.